MontesDeOca with the Equity Management Academy live trading room, live streaming from YouTube. Let's jump right into the market here this morning. Gold trading last at 1825.6. Silver is weaker than the gold market, trading about 26.13.14. If we focus here on trading today, let's take a look at and see where the market is in relation to the daily pivot points here, the Fibonacci pivot points that we use to identify the probability factor. As you can see on the left, we're looking at 1829 for the average today. The buy one level on the daily for day traders is 1822 to 1814. As you can see, the market came down into the 1815-16 area at about 4:15 a.m. and never really came down to 1814, which was the buy two level, and reverted from there, activating a daily buy signal at 1822, which is the current signal that we are in right now. The thing that you want to take a look at is the relationship of the daily into the weekly numbers. And on the right of the chart, you see the weekly numbers at 1824 as the sell one level and the sell two level of 1839. Excuse me. So what does this mean? This means that we have a daily buy signal with a target of 1829, and we are entering into a weekly area of, you might say, resistance, or what the algorithm calls a distribution of supply area. And this area becomes a high probability area that it only has about a 10% probability factor that the price still could rally to 1839. And so it's a bit of a mixed signal, as you can see, but the fact that the market is trading above the weekly 1824 makes that level a support level and activates again the target of 1839. And so we're looking at about $14 still that the market potentially can accomplish and complete the target. If we close below 1824, as you see here, it comes right into an area of support, a daily support, that more than likely this is an area where the algorithm identifies where you should accumulate supply. The area in blue is accumulation of supply. So we're going to maintain our core position, which is looking for the target of 1839, obviously. And we're prepared to buy corrections, as I have been suggesting in my live trading room, that this level is to get on the long side of the market daily with targets of 1829. From 1822, that's a $700 trade for day trading is a pretty good trade. Let's take a look at silver here. The silver market is a little weaker this morning, highly volatile. and it's in the buy 2 area. It's activating a trend alert. A close about 26.15 is going to activate a buy trigger. Right below 26.15, we have the 360-day cycle of 25.85. So silver is in an area of support as well. The market is in a choppy area at the extreme below the mean, and it's trying to identify basically uh, the support for basically the next rally that I think is going to be challenging that 1835 area. We are in a bit of a ambiguous mixed signals between daily and weekly. So as far as your instrument is concerned, if you are trading on the long side of this signal here in the gold market, um, conservative traders can use the 1822 as your protective stop. 1829 or so is the target for the trade that went long at 1822, as you can see here. I think the market is trying to digest the fundamentals relating to interest rates or inflation. And I think what we're looking at is the market deciding or identifying whether this inflation is going to be temporary or it's going to lead to something of a longer term duration. And you know, I take a look at the 10-year note to see what the short end of the market is telling us as far as interest rates are concerned, and the 10-year note is slightly higher this morning, up about 2.5 basis points at about 132. But we are still considerably down from the high that we saw of about 177 just a little while ago. So the 10-year note obviously is not screaming inflation. Rates are coming down. So there is a bit of a, again, conflicting picture with regards to what the market is saying about inflation and what the indicators are saying about inflation, which really are running at 11-year highs. The producer price index came out yesterday. It was at 7.3% annualized, excluding food and energy. I think it was at about 5.3%. So there's no question that we have prices pressure moving up as a consequence of the shortage that we have bottlenecked, so to speak, in the supply chain. But I believe that once the supply chain is more normalized, then we're going to be looking at some of these prices here coming down. It looks like we have a little bit of a sell-off going on in gold and silver here. So if you enter into the long side at 1822, I would be stopped out on a closing basis. If it closes below 1822, in gold, I would just go flat here, and we seem to be getting a bit of a sell-off. So let's the sell-off take place, and we'll see what kind of buying we're going to be looking at these levels here. Let's watch the market here trade into this area and take a look at this. One of the things that I want to point out that I suggest to my traders in the room is that if we enter a trade, when I say maximum dollar risk, that is a maximum dollar risk that you should be able to comfortably afford. For myself, it's $1,000 a trade. So if the market comes down $1,000 against me, I automatically get out and take a look at it again. Or if you conservative, then follow the levels that close below the signal or the pivot point. In this case, 26.15. Or if you're prepared to buy into the 360-day cycle that have essentially that has shown tremendous support. If it goes down to 25.85, that's where you can add to your positions if you're holding on multiples, if you're looking to add multiples. And I'm very interested to see if we do go down to 25.85. That is a 360-day cycle by one level that essentially coincides with the gold market yearly average price of 1810 is a very key level here, and so we kind of correcting into those levels that are major critical levels here, and let's see what the market does here at this point. This would be considered extreme high probability trigger points. So let's just see in a fast market condition here what's going on. This correction here should be a counter trend swing correction that should essentially trigger uh, a lot of support at these levels here. So I want to see the market prove itself here. I want to see the market trade in this area, but this would be the area where mathematically it's telling you this is where you want to be adding to your core position long term, if not in futures or stocks or ETFs or even options at this point. This is a counter trend signal. We're looking at support here at this level, so continue to hold on and look for the path of least resistance from these levels, which is essentially that the market should revert back up above 1822. The market is trying to define, obviously, the supply and demand that's available here. And what we want to see is more buyers, more green bars here, which essentially means that buyers are accumulating at these levels, which is what the AI recommends for you to do. Let's take a look at the E-mini S&P, which is slightly higher here, but it looks like it's completed the target. As you can see, the sell one level of 43.68, and pretty much that's what happens here when the price reaches the target. It goes neutral, and it waits again for the next signal, the highest probability signal. So um, it also gave you a chance here to revert and go short. So we've accomplished, you might say, the extreme below the mean signal here a few days ago around the 43.30 area, and now 43.68. It's been completed, and the market is in a corrective pattern. The volatility is tremendous. Once again, adjust your trading to this volatility here that is truly unprecedented. Um, and that's pretty much across the board, particularly for digital currencies. We activating a trade alert here from 1814 on gold, the buy 2 level. And silver 25.92, extremely oversold. $18.14 is the trigger point. $14.30 was the low. So look for reversions possibly to unfold from these levels in blue. This is what the AI tells you, is that this is the area where you can expect reversions to unfold. Slowing down here quite a bit. I want to share with you here the latest report that we published in the Associated Press and was published this morning on Seeking Alpha. And the title of it is Gold, Extreme indifference can make a long-term cyclical bottom unfold. There's a tremendous amount of indifference in the gold market, as you can see, based upon the fundamentals that we have. Summary. July 15th morning, the unemployment claims came out at about 360,000, which was expected, and the 10-year note is trading at about 131, 132, down a couple of percent. The market is still digesting the CPI news and the PPI, which indicates that inflation is running above expectations. There is a great concern that if interest rates rise, we could be in for a rough time ahead with current debt levels. If the supply chains can meet the tremendous demand that is coming back into the economy, then inflation may not be as bad as some fear. Looking for portfolio of ideas like this one, members of Mean Reversion Trading can get exclusive access to our model portfolio and Seeking Alpha. This morning, July 15th, the unemployment claims came out at about 360,000. Which was expected, and the 10-year note is trading at about 131, 132, down a couple of percent. Gold is trading at about 1825.90, up about $1. It is fairly quiet this morning with not much volatility. As we write this report, the market is still digesting the CPI news and the PPI, which indicates that inflation is running above expectations. The big question is whether this inflation is going to be temporary, as the Fed suggests, or is it going to be long-term? The 10-year note is trying to identify exactly how that will affect the market. The 10-year note is down about 298, which is indicating the opposite of inflation. It is confirming that inflation numbers could be temporary. We watch the note carefully because if interest rates rise on the 10-year note, then inflation could be a problem, which could lead to a problem in the credit markets and a possible credit squeeze. There is a great concern that if interest rates rise, we could be in for a rough time ahead with current debt levels. If the supply chains can meet the tremendous demand that is coming back in the economy, then inflation may not be as some fear. The 10-year note shows that most investors believe that inflation is temporary. Lumber, for example, which is a key component of construction, that price has come down to 610. We were trading in the 1700s just a short time ago. So we have seen a major collapse in lumber prices that should eventually lead to a decline in most construction and maybe the runaway market in real estate. The 10-year note has removed the pressure of price inflation. We are seeing an increase in the PPI, but we are still waiting to see how long this will last. We have a mixed picture right now. We have seen a tremendous amount of equity pumped into the real estate and equity markets. We are also seeing stimulus continuing to come into the market. The Fed balance sheet is now more than $8 trillion. At a time of record savings. The world is now flooded with cash. The key is how fast this cash will enter the economy, which will determine whether this is inflation for the short or long term. We will have to see if the amount of stimulus is depleting the value of the assets in dollars, as the dollar declines in value. Since 1971, when we went off the gold standard, we have been exporting inflation in a way to the rest of the world. Since then, the dollar has been declining in value. We may be at a point where this stimulus may be jeopardizing the purchasing power of the US dollar and every other fiat currency. The pressure is going to increase on how we're going to taper off all of the stimulus and then have to pay the increased level of debt while maintaining the purchasing power of the US dollar. Right now, we appear to be dealing with a transitory spike in prices due to a bottleneck in the supply chain and increasing shipping costs. We are going to continue to see prices increase until possibly the end of the year. Then we will see where interest rates are going to go, which will be a key factor in where markets will go. Recently, Chairman Powell was able to cool off the market, but he might not be able to do it again. It looks like we're running into a bit of a correction here today, into an area that is extremely oversold in the market. So continue to hold on to your core position, and if you got stopped out in the day trade, look to re-enter upon confirmation of a new trigger point. In the meantime, thank you again, everybody, for the opportunity to share this incredible information with you here, and I truly hope that you are making a difference in your trading by coming here. So once again, thank you. Have a great trading day, and we'll talk